Imagine the worst case scenario. You wake up, you check your phone, and you see that your broker's gone bust. Overnight, everything has gone from this...
Yes, everything is fine.
...to now a bit more like this.
And then kaboom!
So the big questions are, what happens to your money, what's protected, and what happens next to your investments? Let's run through everything because I still think there's a lot of confusion here in the UK about how this all works, and I still see comments all the time on my videos asking this very question. Right, starting from the top, let's run through what we have set up in the UK. The financial services sector is highly regulated, so there are a load of rules out there that companies need to follow. The big boss at the top is the Financial Conduct Authority, or FCA, represented here by David Brent. They're responsible for looking after the whole industry, and they make sure that everything is working well. In their own words, they regulate the conduct of nearly 50,000 businesses in the UK to ensure that our financial markets are honest, competitive and fair. To enforce this and make it happen, they can also issue fines and take companies and individuals to court. Now, for some perspective, in 2021, they issued fines with a total of £567 million.
You naughty.
Now, in terms of the protections that we get as investors, here's where the next layer comes in, represented here by good old Gareth Keenan. This is where the Financial Services Compensation Scheme slots in, and this is a separate body that's accountable to the FCA, but it is independent. It's also paid for by the industry, so if you are a regulated body, you'll have to pay a small slice of your income to cover their costs. And this is where your protections come in, as the job of the FSCS is to provide a compensation service in the event of things going wrong. So how does this all work? Well, you might already be aware of this, but the FSCS offers compensation of up to 85k per person per company. And these companies can include banks, building societies, insurance providers, pension providers, and importantly for our example, investment brokers. Now, what does this mean in practice? Let's run an example because I think a lot of people mix this part up. Gareth Keenan, let's dive into what you cover.
Quiet, please. Investigation in process.
Okay, so let's start with a really simple one. And so you have two bank accounts. You're lucky enough to have 50k in one and 100k in another. One's with Nationwide and one's with Barclays. Now, the rules say that in the event of your bank going bust, so let's assume that both of them did in this scenario, like some of them did back in the global financial crash, you're covered by up to 85k per provider. So in this example, you'll get 50k from Nationwide and only 85k back from Barclays. That's because you're over the limit of the 85k protection in that 100k account. Now, just as a side note, if that 100k account was in a joint account, then you would be fully covered as the scheme provides 85k per person, and the 100k would be well under 170k, which would be the limit of a joint account. Right, so that's banks with cash, but that's fairly simple. Investing is where it gets a little bit more interesting. So now let's run an example saying that you have a nice investment account with 200k as a total value. Inside the account, let's say that you have 50k of cash and then 3 other investments in ETFs and some in individual stocks. Just to be clear, this is with a legit broker and the platform is regulated by the FCA and part of the Financial Services Compensation Scheme. Obviously, if this isn't the case and you've somehow managed to invest with some weird offshore dodgy bloke, then you're already screwed.
And it's gone.
Right, so let's say that this broker fails. Unfortunately, management's been too busy focusing on doing motivational speaking and worrying about their own profiles, and they've hired too many staff. They've run out of cash, and now you're thinking, what happens to your money? If we run through each part one by one, here's where you'd stand. Let's start with that cash. 50k is under the 85k limit, and the provider would be the broker themselves, so that's covered and it would get returned to us pretty quickly. Now, what about the investments? So let's say that one of your investment funds was worth 100k and then the others were worth 20k each, and then you had the rest in some stocks. To help the example, let's say all of the funds were Vanguard funds. So now you're wondering, okay, I've got an investment here of over 85k. Does that mean I'm going to lose the rest and I'm not covered? And the answer is no. You see, the broker and the investment are two very different things. And this example, Vanguard would be completely separate from this broker. Let's say, for example, that the fund you invested 100k in was a simple index fund that invested in the S&P 500. Even if the broker you use to buy the fund goes bust, the fund still remains the same and nobody loses any money because ultimately this fund is made up from all the investments. All of the value of that fund is determined by what's inside of it. And in this example, you'd have millions, possibly even billions of shares owned by thousands of different people and organisations. That fund doesn't change at all. What might happen though is that you would probably not be able to make any new buys or sells in your investments, and you'd have to wait until the regulators have worked their way through the bankruptcy. What would end up happening is the investments might get moved to a new broker or platform, or even get sold and that cash returned to you. But either way, it wouldn't matter if you had 50k or 500k inside a fund in that example. The broker does not have access to that fund and they can't just dip inside that money and take that with them. Also, it would be the same with any stocks. Let's say that you had 10k worth in Tesla. Even if the broker goes bust, you still have 10k worth of Tesla. Those shares are held in a separate account, and again, you might not be able to sell it or buy anything until the FCA sorts things out, but you would either get the investment moved to another platform or maybe even have them sold for cash. And if we're trying to use references from the office to keep this video going and interesting, you'd probably say that your old investments might get taken in by another broker, aka the Swindon lot get taken in by the Slough team, and they all continue to work happily ever after.
Settling in, having a good time? How is it different?
Funny enough, I can't actually find any examples of investing apps going bust to show you what would happen in practice, but there have definitely been a couple of major failures in the past where the FSCS have had to step in. Now, firstly, there was a broker called Beaufort Securities back in 2018 that got caught up in some dodgy dealings. Now, long story short, but this company was part of a Wolf of Wall Street style pump and dump scheme. They tried to defraud investors and also even tried to launder money offshore and even buy a Picasso painting to do it. Now, thankfully, investors did get protected and had their assets moved to another firm, but they were left in limbo for a while as the regulator had to sort things out. Then secondly, another recent example was one of Neil Woodford's fund, a guy who was super popular as an investor a few years back. I guess he can be our bloody good sales rep Chris Finch if we're keeping this office themed. Anyway, his fund ran into trouble as he was investing in things that were not easy to sell. In other words, they were illiquid. And the fund ran into trouble when big investors wanted their money back at the same time. In this example, I guess we're now saying, well, what happens when a fund fails rather than the broker itself, as this is pretty important. So in this example, again, to keep things short, investors did get some money back, but this process is actually still ongoing. The last report I read said that investors got back about 77p to every pound, but this has been going on for years and it's still not resolved today. So what does happen if an investment goes bust? Well, in short, you're not covered, at least most of the time. If you make an investment, for example, in a stock that goes bust, let's call it Wernham Hogg, there's nothing to come back from as this is the risk that you take when investing. The compensation scheme is not there to give your money back if your investing decisions don't work out. It would also be the same with the mutual fund or an ETF. For example, let's say that we're invested in a fund that's super high risk because it uses lots of debt to buy property and then the market crashes. You could end up in a situation where the fund provider fails, and in that example, the regulator might step in to recover as much as it can, but there's no guarantee for you because the investment was your own choice. Now, maybe you'd get back something, but there'd be no guarantees. Now, if you were invested into something that was much simpler, let's just say you owned a global index fund from Vanguard, and Vanguard suddenly said, sorry, we've got no money left, that's it. The fund still has value on its own, even without the Vanguard name attached to it, because it would own the entire global stock market. None of the value's lost because the fund itself still owns a ton of that stock, and the stock's value is ultimately determined by the market itself. Again, as I mentioned before, what would probably happen in that example is the fund would be taken over by another big provider, or the worst case might mean selling the fund and just giving investors their share of the fund back. There'd be no guarantees though, that would just be at the market price as that's the risk of investing. But one thing we can say with certainty is that you're not going to lose all of your money inside a global index fund. The world would quite literally have to be over and nobody would want to own stocks. And at that point, there'd only be one thing left to do. Isn't that right, David?
Spaceman came down to answer some things.
So all things considered, hopefully that makes a lot more sense now. And I think that you should realise that investments are very different from, say, just holding cash in a bank account. Now, just on a side note, here's my own personal thoughts and just some ideas that you might want to consider before that you invest. Firstly, for any broker or platform you choose, I would never ever invest unless they're regulated by the FCA and part of the Financial Services Compensation Scheme. To check this, you can go to the FCA website, type in the name of your broker and confirm that it matches up to what you're seeing. That for me is an absolute minimum. Secondly, I'd also consider the broker based on their size, if they're profitable, and I think if they're trustworthy or not. Now, this isn't something that's going to be the same for everyone, and here's where your own judgment would need to come in. But for example, there are some newer platforms out there, especially the very low cost ones, who are still not profitable and potentially could go bust at some point. Now, this doesn't mean that you don't want to use them, but it could be something to consider. Again, for example, what about if you were taking money out of your investments as part of your retirement each month and then your broker goes bust? Now, this would definitely cause an issue. You'd not lose your investments as you spoke about earlier, but you might lose access to them until the regulator sort things out, and that could be weeks or maybe even months. So don't forget to think about things like this. Although I'm sure, like me, you'd like to keep your investing cost to a minimum, you shouldn't just think about cost, and it should be one part of what you actually consider in total. Now, as I said earlier, personally, I'm not bothered about crossing more than 85k in my investments, and I'd not hesitate having many hundreds of thousands in a single index fund from the likes of Vanguard as an example. But everyone's different, and if you really want to diversify with your providers, that you're more than welcome to mix and match and spread your investments across many of them. I mean, you could, for example, use multiple index funds from different providers and then also use different brokers. You might have a few different personal pension accounts, a couple of ISAs, and even a general investing account, all with different platforms. That's completely up to you. It's also worth saying that everything we're talking about here is the worst case scenario, and thankfully, this is extremely rare. And here in the UK at least, we've got a highly regulated industry where your money is protected. On a very brief tangent, just to reassure some of you out there, but there is no limit of protection in terms of pensions from annuities. So you don't have to worry about having pensions worth more than 85k, for example. They make this very clear on their website. And also, if you ever find yourself with loads of cash in the bank from a sale of a house or something, you're also protected up to £1 million 6 months from the date that your money goes into your bank account. Now for me, I've got several accounts myself. I'm with Vanguard, Trading 212 and InvestEngine, and they each serve a different purpose for me. All of these platforms are regulated by the FCA and protected under the Financial Services Compensation Scheme, and I'm happy with that as my own level of risk. But for you, that's a personal choice that you'll have to make. Anyway, I'm running out of things to say, and I don't think I can make another office reference for now. So if you want to watch my latest Vanguard portfolio update, here it is on screen now. Better click it before the video goes
Kaboom!
I'll answer your questions, I'll answer them true. I'll show you the way, you know what to do.